Welcome back to the channel. I hope everybody's doing well. This video I'll be going over 3 stocks which I think can offer fair value at a time where prices of everything, including the stock market, seem only to be going up. I've got 3 really different picks here, which all offer different in regards to risks and rewards. And the first stock we'll have a look at here is a large cap healthcare company who could appeal to value, dividend or dividend growth investors looking for a stock that isn't as volatile as a high growth stock and offers a very respectable dividend yield. I won't read through all this information, but Amgen, summed up briefly, are a human therapeutics company focusing on oncology, hematology, bone health, cardiovascular disease, nephrology and neuroscience areas. Hugely successful company and have a large catalogue of therapeutics and have been around since 1980. They also have collaborations and joint ventures, and the one with some buzz around it at the moment is their partnerships with BeiGene, who they hold a 20% stake within this company. These guys are based out of China and they focus on cancer treatment drugs. As of 2020, BeiGene's generated about $390 million in revenue, but are still losing money at the moment. Top line revenue of about $1 billion is expected by the end of this year and continue to grow at about 10 to 20% out to 2023. The share price is down towards its 52 weeks lows, offering a very nice dividend yield of about 3.18%, and it offers fair value with a forward PE at around 12. Amgen have been able to grow their revenue at a steady pace, on average at mid-single digit growth rate. 2021 isn't expected to be Amgen's best year. In fact, it's forecasted to be their worst year from a net income perspective since 2018, which is why the share price has lately been struggling to gather traction, creating this dip which could be seen as a good entry point into this company. Net debt has been growing over the last few years, but doesn't seem to present an immediate risk, with forecasts that this will be getting paid down over time. As I've taken this information, the current yield is about 3.1 to 3.2%, payout ratio of about 43%, and it's had 9 years of continued increases. Looking at the 5-year dividend yield chart, we're getting into good value territory based upon where the yield has been sitting within the last 5 years. And if you're lucky enough to scoop this up in 2011, you'd be sitting on a huge yield on cost of about 11 to 12%. Q2 results beat analyst expectations with 5% revenue growth, but they did change full year GAAP EPS from $9.11 and $10.71 down to a reduced range of between $8.84 and $9.90, which is why the share price has recently been struggling. And if there's one thing we know about the stock market, is they're always looking for growth catalysts. One good piece of information is at the bottom here, where they're guiding that they'll be repurchasing shares towards the higher end of the previous guidance, which is a range of between 3 and 5 billion. Looking through Q2 results, we can see that their main therapeutics with year-over-year comparisons. Looking at the top 5 drugs, we have Enbrel at the top of the pile with sales at 8% down from last year. Prolia is up 24%, Xgeva is up 12%, Neulasta down 18%, and to round off the top 5 we've got Aranesp down 5%. Totally apologise if I've murdered any of the pronunciations. With the ongoing pandemic, people haven't been attending hospital appointments and getting diagnosed as frequently as pre-COVID, which could be a reason why some of these top sellers are not growing year over year. However, overall, their total revenue was up 5% and sales up 3%, showing how well positioned they are across a pipeline of multiple therapeutics. Lumakras has recently been given FDA approval and is a drug which could be one of the top performers over time. The drug treats adults with non-small cell lung cancer that is spread to other parts of the body. It's currently been given to 2,000 patients. Initial feedback is positive and they've been calling it a breakthrough medicine. The section I have highlighted shows that it's generated about $77 million in this quarter, but could generate well over $1 billion by 2023. And as we already went over, the bottom section mentions that some of the best sellers have slowed down in growth, and this could be a real growth catalyst going forward. Overall revenue up 5%, non-GAAP operating expenses up 15%, non-GAAP income down 4%, with net income up 2% and EPS up 4%. Share buybacks, as we mentioned, have went up 3% also. Free cash flow down $1 billion, share repurchases up $1 billion, dividends paid per share up 10%, with $8.1 billion in cash and $32.8 billion in debt. Price targets from TipRanks has an average price target of $249, which would give you a 10% increase from current levels at the time of recording this video. So not a stock that will make you rich overnight, but with a growing dividend yielding over 3%, reducing outstanding shares, this could play its part in a good exciting growth stocks that I've got here as good buys for this month. The second stock of this month is a company which right now has an extremely attractive valuation, and this is Micron Technology, who are another large cap company and specialise in memory and storage products. These technologies include DRAM, which is the type of memory you'll find within the likes of PCs, graphics cards, and video games consoles. They also offer NAND memory, which is a very similar type of form of flash memory, which you'll find in the likes of SSDs, USBs, and Micron have been around since 1978. And with the computer boom still expected to continue with supply issues in hand, they could be set up to perform nicely here over the short to medium term. And as we've just mentioned, the share price right now is sitting at about $72, with a forward PE of only 6.4, price to sales only at 3, and again they've got a huge market cap at $80 billion. The share price is just coming back down after having a huge run up from about November 2020, where now it looks as if it could be kind of bottom out and looking for the next direction. Since 2018, revenue has been gradually decreasing from $30 billion in 2018 to $21.4 billion in 2020, but now things are starting to take a turn for the better, and in the next 12 to 24 months paints a really good picture here. Revenue from now out to 2023 is to increase at a staggering rate, with revenue expected to reach around $40 billion in 2023, nearly double what it was in 2020. Earnings per share is to follow an attractive pattern, and if you're into dividends, Micron has started to pay out a dividend. A very small dividend, but a dividend nonetheless, and the balance sheet is in phenomenal shape with net cash of around $3 billion. And with forecasts out to 23 being so bright, share buybacks and dividends could be how the excess cash is being distributed, so good news for shareholders. Micron beat analyst expectations with revenue growth of 36.4% year over year and bringing in gross margin up to 42.1% from 32.4%. Guidance for Q4 is to be around $8.2 billion and also raised guidance for non-GAAP earnings per share from $2.15 to $2.30, which is very bullish. The dividend that Micron have distributed is 10 cents with a yield of about 0.5%, which will get paid out on October the 18th. Looking into their Q3 earnings, here are some of their highlights. Data center, DRAM grew quarter over quarter. Data center, SSDs the same, and the data center demand is expected to be strong going into the second half of the year. PC and graphics have performed exceedingly well, with growth into the high teens due to the boom within PCs and notebooks. SSDs also up alongside graphics, doing very well, driven by next-gen consoles and graphic card shipments. Mobile recorded record quarterly revenue, with mobile sales expected to show healthy growth this year as 5G continues its rollout. This is how Micron's revenue is split between its products, DRAM being the main driver with 73% of total revenue, up 52% year over year. NAND is 24% of total revenue in this quarter with a decent growth of 9% year over year. Wall Street are super bullish on Micron, with 16 out of 22 analysts giving them a price target on average of about $112, which is up 57% from current levels, which would be a huge return over a 12-month period. I must admit, I do really like the look of this company, and with the added prospect of being a dividend growth company, it makes it super appealing. Last on the list here to tick off the last one on the list here is another totally different company, and this is Plug Power. Plug Power provide hydrogen solutions for electric mobility and stationary power markets in North America and Europe. It focuses on proton exchange membrane fuel cell and fuel processing technologies and fuel cell battery hybrid technologies, as well as related hydrogen and green hydrogen storage dispensing infrastructure. Small company just now with over 1,300 employees and have been around since 1997. With the move towards green and clean renewable energy, Plug Power could have a really bright, excuse the pun, future ahead of them. The share price had an absolutely phenomenal run up from 2020 into the start of 2021, where it peaked out around $75 or so, and it's been coming back down, and it looks to have identified a solid bottom around the $20 mark, and it's recently been consolidating to work out what move it wants to go. There's no PE metrics in this company just now or anything like that, as it's currently running at a loss. Being a company carrying out an aggressive growth plan over the last few years, they're running at a loss, as I've just said, and expected to continue this up to 2023. Revenue is expected to jump up in a huge way this year and out into the future, with projections of over $1 billion in 2023. Balance sheet is in pristine condition, sitting on an abundance of cash of about $2.6 billion, which gives the company plenty of room to manoeuvre to fund growth strategies. Looks pretty bullish to me. Plug Power's revenue came in hot in their last earnings report, beating expectations by $13 million, with revenue up 83% year over year. Growth in the electrolyzer business is estimated to be up 400% in 2021 compared to last year, with robust growth levels forecasted out to 2024. The CEO has come out and raised guidance this year up to $500 million, with setting a goal of $750 million for next year. I just wanted to show again how solid the balance sheet is sitting right now, with cash of $3 billion and assets well outweighing liabilities with very little debt in hand. The only drawdown here is share dilution. Plug Power have continuously issued new shares each year to raise money, meaning if you're a shareholder, your piece of the pie is getting smaller and smaller each time. Looking through their earnings reports, I found some interesting joint ventures like this one with Renault, where they've teamed up to launch a 50-50 joint venture to target 30% of the fuel cell powered commercial vehicle market in Europe, which is expected to be around 500,000 in 2030. The last paragraph mentions that several teams have relocated to join the team in France and expect to launch the first 3 fuel cell vehicle models by the end of the year. Exciting stuff, and fair play to Plug Power showing commitment by relocating to France. I really like this next article where it mentions their growth in building their third announced hydrogen power plant in Georgia to serve customers in the southeastern United States. It's 100% renewable and is intended to fuel transportation applications, including material handling and fuel cell electrical vehicle fleets. They have started work in August and plan to have the first green hydrogen plant phase up and running before the end of the year and expect to be operational in summer 2022. In July, Plug Power finalised a 345 megawatt wind power purchase agreement with Apex Clean Energy to commission their first and largest onshore wind powered green hydrogen production plant in the world. This will have the ability to fuel over 2,000 light commercial vehicles or over 1,000 heavy duty Class 8 trucks. Last mention of joint ventures is with BAE, where they're looking to rely on their 25 years experience with zero emission solutions to develop and power electrical buses. BAE is a company I already have in my portfolio, which is actually pretty cool, and this partnership looks a good fit as BAE have been an advocate of using hydrogen since way back in 1998. Little look at the financials before we round up the video. Revenue, as we said, was up 83%, but on the flip side, the total cost of revenues doubled at the same time, evening that out. And as I mentioned about share dilution at the bottom, it shows that last year there was about 316,000 shares, but now it's got 567 shares in circulation, which is up about 80% year over year. With all that being said and done, let's see how analysts are taking to the stock. Average price target of $41.47, which would give you a very impressive return of about 63% based on current prices. It's got a few headwinds when it comes to losing money just now. Definitely a lot of tailwinds which could take them on a really exciting journey, and you could be a part of it if you're a shareholder. I hope you've enjoyed these 3 picks. They're all something different, and if you're still here at the end, please drop the video a like, leave a comment, and I'll catch you in the next video. Thanks.